We did think that they would hike today, but we thought that this would be the last one. We were a little bit puzzled in March that the Fed staff was forecasting a recession, and the committee chose to hike. But I think we got some explanation of that today. Chair Powell, as you just heard, does not expect a recession. And so my best guess is that the committee decided they would go a little bit further, but then stop here. The message is pretty clear that the bank stress is not just hypothetical, that its impact on credit is now real. They're seeing evidence of that, presumably, not just in the beige book that we've seen, but probably also in the loan officer survey. And Chair Powell talked today about how rate hikes, balance sheet reduction, and credit tightening can add up to something that might well be enough to get to a place where inflation starts moving in the right direction. So our baseline expectation is that they pause at the June meeting, and that seems like a reasonable place for them to be.
And David, a question from me regarding the interest rate sensitivity of the economy relative to the lag between interest rate rises and when it starts to impact the underlying economy. Over time, that sensitivity has declined, and I'm just not sure. Curious, what do you think is most important? Is it the pace of the rate increases, the magnitude, or the absolute rate that we arrive at? And what, in your mind, is that lag before it really starts to impact the underlying economy?
Sure, I'd make 2 points here. First, the starting point when the clock starts ticking is really when financial conditions tighten in anticipation of those rate increases. Our Goldman Sachs Financial Conditions Index actually did the great majority of its tightening in the first half of 2022 because markets gradually came to realize that further interest rate hikes were coming. So in that sense, the kind of spark for all of this was actually quite a while ago at this point. We're already in May of 2023. Second point I would make is that our model relating changes in broad financial conditions to economic outcomes, and this is quite consistent actually with what you see across a broad range of academic and central bank macroeconomic models, it would say that the largest effects on GDP growth are felt about 2 quarters later. Some models will say the same quarter, some will say 2 quarters later, some will say 3 quarters later. So if financial conditions did their bulk of their tightening in the first half of last year, 2 quarters later, that would be the back half of last year. And I think we see that borne out in the economic data for the most interest rate sensitive sectors like housing that did their most abrupt adjustment in the back half of last year. Purely from the perspective of interest rates and market-based financial conditions, I think the peak impact is behind us. Although if you also include the impact of tighter lending standards by banks, then I think the right answer is that we still have more restraint on demand growth. It's larger, it's a little bit longer lasting. And I think that's the view that the Fed has come around to, that you do want to take account of that additional impact of tighter bank credit.